If you work at a pre-IPO company and have equity stock options, restricted shares, or anything with a vesting schedule, there's a 30-day window that most people don't know exists. Miss it, and you don't lose your equity. You just pay significantly more in taxes than you have to. I'm Randa Hoffman. I'm the lead financial advisor and owner at Radiant Wealth Planning. Today, I want to walk you through the 83B election, what it is, which equity types it actually applies to, and the downside scenario. So, what is the 83B election? When you receive equity in a company, think about shares, options, founder stock. The IRS generally wants to tax you when the restriction lifts, meaning when the stock vests and become fully yours. The 83B election lets you flip that. You're telling the IRS, tax me now on the current value before the stock appreciates. In return, any growth from this point forward is treated as capital gain, and that's taxed at a lower rate and with long-term holding clocks starting immediately. So someone at a pre-IPO company where shares are currently valued at almost nothing, that means a small tax bill today in exchange for potentially significant long-term capital gain treatment later. So the difference between ordinary income and long-term capital gain on a meaningful equity position can be hundreds of thousands of dollars. Who does this actually apply to? This is where I want to be specific because there's a lot of confusion in this area. This 83B election applies to restricted stock awards, shares granted outright but subject to vesting, early exercise ISOs and NSOs options you exercise before they fully vest, founder shares. These are typically issued at nominal value with a vesting schedule. Now, RSUs do not apply, generally, do not apply. If you're not sure what type of equity you hold, that's the first thing worth clarifying because the answer is going to determine whether this conversation is even relevant to your situation. So here's the downside and why it matters. I want to spend time here because the election is often presented as a no-brainer. It's not. When you file the election and exercise early, you're paying tax today on shares that never may fully vest. If you leave your company before vesting schedule completes, the uninvested portion is forfeited, and the IRS isn't going to give you your tax payment back. There's also an AMT consideration for ISO holders. This creates an alternative minimum tax preference item, the spread between your exercise price and your current fair market value. Now, if that number is large, you could owe AMT in the year of exercise, even if you didn't sell a single share. And the third risk, the company doesn't perform. So you pay tax on a valuation that never materializes. The loss may be deductible, but the cash is already gone. So this doesn't mean that you don't do it. It just means that you go in with the full picture, not just the upside. Now, there is a 30-day deadline. So I want you to remember the deadline, okay? Because you have to make an IRS election within 30 days of the grant or early exercise. And the IRS isn't going to grant an extension. There's no late filing provision for this. So you miss the window means you're going to miss the election permanently. Most people find out about the 83B election well after they've joined a company. And if that's you, the question now is whether any future gains or exercise give you a new window and whether you're positioned to move quickly when they do. The election is one of those decisions that looks simple on the surface and it gets complicated fast once you model the actual numbers. Your specific strike price, your company's 409A valuation, your AMT exposure, your realistic departure risk. If you found this helpful and want to go deeper, I've written a full article on this topic that walks through a real client scenario, the full picture, both paths, and how the decision actually gets made.